Good evening, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, we separate currents from noise and opportunity from fear using closed-end funds and an income-focused strategy. This isn't polished, it isn't scripted, and it's definitely not hard thinking. We don't chase headlines, we navigate markets. I'm not a financial advisor, but I am a strategist. I go where the data leads, even when that means walking alone. So, welcome back. Really, the big news of my week, financial week, is I finally sold FSCO. Why? Because the current didn't suddenly change, it finished shifting. I said for a while now that the financial current favors bonds over almost everything else. And out of the four major sectors, bonds and bonds proxies, end-to-end energy, technology beyond the large caps, and the real estate sector, bonds have been the leader. And FSCO sits in that gray area. It's labeled like a bond fund, but it operates more like a business development company. And when rates were higher or even stable, it worked. But we're not in that environment anymore. We're in the transition between higher rates and lower rates, and everything points to lower. A Federal Reserve leadership change is coming, and the next chair has already signaled a willingness to cut rates. Oil production is increasing, which is deflationary. AI is deflationary, and GDP is still growing. If you put all of that together, the direction becomes clear. We're moving to a lower rate environment. And BDCs in that environment, well, when rates are high, BDCs work well. They lose strength as rates fall. That's not opinion, that's just structure. And FSCO's dividend cut wasn't about panic, it was forward looking. It was a reflection of the coming market, not the current one. And that matters because it tells you the fund manager sees the same shift. So why sell? Because even though FSCO still offers strong income, it's no longer aligned with the strongest current. Could I hold it and wait for rates to cycle back up? Yeah, sure. But it means sitting in the wrong current, waiting for the market to come back to me. And I don't want to wait. I want to move with the market as it is now. So I sold it at a loss. But that's part of the process. What slowed my decision wasn't the data, it was the environment. We're in choppy waters right now, choppy financial waters right now. Iran versus the US, Iran versus Israel, Iran versus its former allies, and China losing its primary oil supplier in the ramp up to President Trump and President Xi's meeting in May. That's key. So, at a certain point, when conflict surrounds everything, it's not the system that's unstable, it's the source. And all of that noise is happening while 20% of the global oil supply is tied to a region that isn't even critical to US energy needs. So what you're seeing in the oil prices sector, that's not supply and demand. That's fear. So what did all the drama and the noise do to FSCO? Well, over the last 2 months, we had that private credit scare, but that those fears seem largely overblown. But FSCO still dropped in price and they cut the dividend. And then the price recovered a little bit and then it stalled out. No real trend, no real recovery, just movement inside noise. And in this kind of environment, waiting for clarity can turn into waiting too long. So I stopped waiting. What really pushed me over the edge of selling was the fund manager's commentary, which I found online. So selling FSCO wasn't just about exiting, it was redirecting capital. And the way my portfolios are aligned between the Roth and the cash brokerage. For the Roth, I want, I guess you could call it more of an anchor strategy. And the goals are simple: stability, consistent income, low volatility. That leans heavily towards bonds, something that can sit, produce, and not require constant adjustment. Now, I'm not going to abandon the portfolio, it's still going to be actively managed. but it could be a set it and forget it if I really had to, but I'm not going to. The cash brokerage is more flexible. I'm more willing to bend. I'm more willing to be aggressive without being crazy aggressive. So maybe we call that more open. There are core anchors like bonds and municipal bonds, but I also have targeted positions based on market cycles. Of those, not everything is held forever. Some positions are meant to move, but the goal is to generate income, capture opportunity, and then redeploy the capital, always pushing the money forward. So where does all this leave us? The currents haven't changed. We're still working within the same four financial currents: bonds and bonds proxies, maybe not all the proxies, but bonds and bonds proxies, energy, end-to-end energy, technology, which would be AI and software too, and then real estate. But bonds are still leading unless a clear opportunity shows up elsewhere, right? Unless we're still going to target bonds and focus our capital there. So, with that in mind, let's move into this week's closed end fund snapshot, look at the funds, and then align those based on the currents. So, here's what that looks like right now. Let me share my screen. And you end up with this. Now, this black bar we'll get to, but this is the cash brokerage at the top. This is the money I have, this say dividend money, the sale from FSCO, give or take. This is what I have. The goal is not to spend it all in one setting. The goal is I would bifurcate it into two buys. So of the options, we've got real estate and real estate, this four pack of bonds, and then BRW, which is a bond portfolio, but it's much more just like a credit engine. And I'm gonna hover over these boxes so you can pause the screen and read whenever you need to. BRW is aggressive when it comes to its credit approach, and Boaz, I've already read Boaz has started buying up private credit losses or private credit packets. So while its sister fund, or how I labeled them in my portfolio, I would buy BRW and FSCO together. So while I've sold FSCO, I would still buy BRW. One, based on what I hear, what Boaz Weinstein is doing. Two, it's a phenomenal dollar cost average deal at the moment. So a small pack of it is really a good deal for me. But I'm not buying IGR or RFI. They are bond proxies. Real estate, yes, is a bond proxy. IGR is a dollar cost average move, but it's been less. And RFI is currently on discount, but it's actually more than my buy-in price, and it too has been less recently. So how to say this? So I sold FSCO to push capital forward into the top flowing current of bonds and bond proxies, right? So it's bonds and proxies if I find a deal in proxy. Now, IGR is cheaper than my average share cost, but I wouldn't necessarily call it a deal for me. It doesn't meet my if it was like 430 or 420 from 2 weeks ago, that would be a steal, honestly. That I could go with, but 50 cents higher. Uh, the discount has gone away. It's back in premium. Yes, it's a dollar cost average move, but I wouldn't necessarily call it a deal in this market. RFI fluctuates. It goes on sale or goes on discount here and there. Buying this at 0.5% off is like paying 99. It's like paying 0.995 for every dollar invested. That's a discount barely, and it's about 40 cents higher than my current buy-in price. So it's discounted, but I wouldn't call it a deal. So that leaves me with this five pack, BRW, and then this four pack of bonds. So again, I'll pull out the boxes. You can pause the video and read. PHK, PTY, PDO, and then DLY. Now, of the list, PDO is a term fund. Haven't found that anywhere. Found that in an article last week. Kind of interesting. PHK is the legacy fund. PDO is the term fund. PTY is the more notable fund. PHK, with its legacy fund, is also, for whatever reason, just not as well known as the others. So it just sits at a different price. And then DLY, it's this last sentence is interesting, I guess you could say to me. It's built for stability, which is what I want. It's the CLO part, which is interesting, but Iverson knows what he's doing. So the CLO market has been crazy with that private credit scare. That I don't know if that's stabilizing, but at least that it looks that way on pricing these last few weeks. That being said, it's currently at steel, like at a steel level. So yes, I want to pick it up. These funds have been, not PDO, I bought it recently, but these funds have been on my almost like an anchor wish list. The funds that I want to acquire and just hold indefinitely. And if the bond market ever looks like it's just gonna, I don't know, fall off the shelf, then yeah, we can look at a complete portfolio restructure if and when that happens. But right now, the goal is to buy the anchors and better, I don't know, better structure or build a little more stability into the portfolio. This other section is the Roth, and it's pretty much a mirror image of above. The difference is BRW. My holdings and how those funds are organized. Initially, everything in the cash brokerage was held up in a different account and managed by somebody else until, quite honestly, we got sick of that guy and what he was doing and not doing. So I started I started a individual cash brokerage on my own, and then started the Roth. So I built the structure of the Roth almost like how I want the structure of the current cash brokerage. I want the Roth to be very boring in setup. So that means over time I have some funds to sell. So I'm willing to buy another 100 pack of BRW for the cash brokerage because I currently have 1,900 shares. Buying another 100 pack puts me at 2,000 shares. I can reevaluate from there. In the Roth, I think I've got 600 shares of BRW, and I can hold off on that. And it's overall, I mean, I like BRW, but for the Roth, it is aggressive. And I really want to focus more on just boring bonds. And that's that 4 pack of bonds. Of the funds that are missing, like what other funds would I be looking for? AFW, which if you AFW is more global. So if you think the US dollar is declining, AFW is where I would go. Uh, and then DSL, which I already own in the cash brokerage, not in the Roth, but it just neither of those meet the discount parameters and everything else parameters for the week. So going forward in the cash brokerage, I'm looking for the alignment for AWF and when that would happen. And in the Roth, same idea. I'm looking for the alignment of things. Um, and the currents, I guess you could say, but yes, it's bonds and bonds proxy, all that jazz. But if you think the dollar is getting weaker versus the dollar is solidifying, all of that, um, of when to buy these two. Now, that being said, AWF rarely goes on significant discount. So it's kind of like when it happens, unless the price is just bloated on my end of things, that's probably a good time to buy. And then DSL I already own in the cash brokerage, but it would be picking it up at a good price point in the Roth. So stuff to consider going forward. But this is my game plan for the opening bell Monday. Or to be honest, I might not do this Monday morning, because from the current news of things, uh, Iran is kind of done negotiating, and the U.S. is forming some type of naval blockade. So I'm sure that's going to impact the markets. So if the market dips a little bit um, Monday might not be the time to buy, but we'll see how that plays out. So at least this is my battle plan. This is my overall focus for the week. We'll see how Monday goes and then go from there. So let's see. In closing, if you haven't, if you have not been paying attention to everything going on, the noise is increasing and the surface is churning, but the deep currents are still flowing. Waves will rise. We see this over, if we look back in history, we'll see calm spells and chaotic spells, and currently it's chaotic. So waves will rise and ripples will spread. But our job isn't to chase reflections, it's to position within the flow. Because when you're in the right current, the market does the work. The income continues, and our dividend dump truck keeps getting filled. So that's really all I have for the week. I'll see you next Sunday, and I wish you a wonderful week. Whatever you have going on, I wish you success. I wish you a successful week. And by all means, if you want to leave a comment or feedback on the video, then go for it. So have a great week, everybody. Have a great week, everybody. I will see y'all next week. Bye bye.